In this chapter, we're going to talk about making financial decisions. And one of the critical, important concepts is something called the law of one price. So let's jump right into the discussion of the chapter. So what are we going to discuss in this chapter? We're going to talk about how we analyze projects, right? What is the relative merit of a project? What is the term competitive market? How does that influence managers' decision making? We'll talk about net present value and why it's the correct decision rule for us to make or to use. We'll talk about arbitrage and how that relates to the law of one price. We're going to talk about a no arbitrage price. That is, in a real world, if there was a competitive market price, what should the price be? Right? There is a no arbitrage price if the marketplace is in equilibrium. We're going to show how value additivity can be added. And we're going to discuss something referred to as the separation principle. So let's get right started with valuing decisions, right? How should we quantify the value of a decision? Well, to do this, it's really a very basic concept. We've talked about this probably in many other classes. It is really boils down to a cost-benefit analysis. The challenge we have is we need to get data from many different sources. So there are other areas in the business, in the economy, that we may have to go to get information in order to apply this cost-benefit analysis. And of course, since all of our decisions have an impact about the future, we're predicting things that are going to happen in the future, we know that there's going to be more than a fair amount of uncertainty in the process. So in addition, we're going to also have to quantify and discuss the concept of risk. In a competitive market, this is a place where goods can be bought and sold at the same price. There are a lot of assumptions that go along with competitive markets, such as no frictions, that is, there are no fees or taxes or anything like that might slow down the process of trading. And the importance of this is, if you eliminate all of those frictions, we should ultimately have a marketplace where, regardless of where you go, everything will have the exact same price if they are indeed identical things. So if the value of the benefits of an asset exceed the values of costs in a competitive marketplace, then that benefit, that net benefit, goes to the market value of the firm. This is what's referred to as the valuation hypothesis. If benefits exceed the costs, who gets this value? Who gets that net gain? And it would be the company, and in the end, obviously, it would go to the owners of the company or corporation. Certainly, it would be the shareholders. The phrase opportunity cost is just a method for us to recognize that we could use our money in other places. So if there are alternative uses for our funding, we need to understand what it is we're giving up by doing this thing. That's the essential nature of opportunity cost. We need to review all the uses of our potential funding and cash. Time value of money is very important in decision making, since we are making decisions today based on what we think are going to happen in the future, in particular what's going to happen to cash flows in the future. And we know that as time goes on, the value of a dollar loses its buying potential for lots of reasons, primarily though inflation and the fact that we have this opportunity cost, we could invest in other things. So that will all have an impact on what the cash flows in the future will actually be able to buy. The interest rate that we're interested in, of course, everybody understands what interest rate is. But we're going to start at a foundation to talk about something referred to as the risk-free interest rate. This is the interest rate at which money can be borrowed or lent without risk. Now, there is no true risk-free rate, if you will, right? But we need to have some proxy. We need to have something that we can use as a substitute for this risk-free rate. As we invest in things with risk, we need to have something to benchmark those returns against so we understand whether or not we're gaining better than what we could if we had taking no risks at all. The net present value of a project is the difference between the investment and the present value of its future costs. And we can write this several different ways, right? So the net present value of an investment is the difference between the present value of its benefits and the present value of its costs. We can write that in a formula, right? It's the present value of the benefits minus the present value of the costs. For most projects, the present value of the cost is the investment price. What does it cost to buy the asset today? So we can rewrite this as being the present value of future cash flows minus the investment cost today. The importance of net present value is that it measures the change in firm wealth. It measures the change in shareholder wealth. So as a rule, if you accept projects with positive net present values, that would be the equivalent of buying something that has a net benefit over the costs of doing the project. And again, positive net present value implies increasing wealth of the company. Rejecting those projects then with negative net present value would ultimately have the impact of reducing shareholder wealth. And of course, that's not part of what financial management is all about. Now, if we're making decisions, if we have to choose between a couple of projects, we always want to choose the one that has the highest net present value. If you choose the one with the highest net present value, that is essentially saying you're going to pick the one that's going to increase owner wealth the most. So how we can do this in a simple form is we can use the time value of money spreadsheet. So in this example, you see the firm needs to buy $9,500 a copier for $9,500. Well, as part of a promotion, the manufacturer says, look, I'll let you pay for this in 1 year rather than paying in cash today. If the risk-free rate of return is 7%, is this offer a good deal? In other words, what is the net present value if we could invest at the risk-free rate of return? Well, to do this, we know we're going to get $10,000 is what we'll have to spend in a year. What is the value of that today? Well, in the time value of money, the future value is $10,000, interest rate 7. It's 1 year away. So the value of this is $9,345. So the asset cost in present value terms, $9,345, or you can pay $9,500. Which would you rather pay today? $9,345 or $9,500? Of course, you'd rather take the $9,345. So what this is saying is essentially it is cheaper to buy this in today's dollars or excuse me, it's cheaper for us to delay a year because the value of that is less than if we paid cash today. So there is a net gain, a net benefit ultimately to this shareholder, because the company would ultimately be increasing the value of the company by roughly $155. We can also use net present value again to choose amongst projects. To do so, we need to compute the net present value for each project and then select the one with the highest net present value. Again, just to kind of repeat, right? This alternative, the one that is going to be the largest net present value project, is the one that's going to increase wealth the most. So let's assume we wanted to start a website hosting business. Now, we're back in school. We're going to consider selling this business, right? And within the next year. And investors offered us $200,000 whenever we're ready to sell the business. And interest rate is 10%. So which of the following three alternatives is the best? Should we sell the business now, today? Should we scale back the business and continue running it while we're in school for another year and then sell the business? Again, what this is going to require, of course, is we're going to have some expenses today. So we'll have to spend $30,000 in expenses, but in the next year, we will generate $50,000 in profit at the end of the year. In addition, a third thing is we could actually just hire somebody to manage the business while we're in school and then sell the business. This would actually require us to spend $50,000 in expenses, but that would generate $50,000 in profit at the end of the year. So how would this ultimately look as investing? Well, if you sold it now, you'd have the $200,000. If you scaled back the business, it would cost you $30,000 today. But again, you'd gain $50,000 at the end of a year in profit, plus you'd get the $200,000 that you could sell the asset for. So the net present value would be $197,273. Under the third alternative, it's going to cost you $50,000, but you'll make $100,000 in profit. You'll still get the $200,000. So the net present value of scaling, of hiring a manager to run the business full bore is $222,000. So which technique or which decision should this business owner take? And of course, the net present value is highest for hiring a manager to run the business. Regardless of our preferences for cash today versus cash in the future, we should always maximize net present value first. We can then borrow or lend to shift cash flows through time and find our most preferred pattern of cash flows. This is what's referred to as the separation theory. Again, simply said, managers choose projects based on their economic viability. Once we've decided what we want to do, we then decide how to pay for them. So that's what we're going to do. There's several sections to this program, to this course. So in the end, it's not until we get to the last couple of chapters of this course that we're actually going to talk about how companies get the money they need to buy the things that they want to buy. Arbitrage is an interesting concept. An arbitrage opportunity occurs when it's possible to make a profit without taking any risk or making any investment. So essentially, this is a positive net present value kind of an opportunity that costs you $0. In a normal market, that's a competitive market where there are no arbitrage opportunities, you cannot have an arbitrage opportunity. In other words, you always have to spend some money to make some money. The law of one price is what kind of plugs us into this concept. The law of one price says if equivalent investment opportunities trade simultaneously in different competitive markets, and again, the concept here is they are equivalent, then they must trade for the exact same price in both markets. The advantage to this is really severalfold. Number one is we really don't have to go around to every supplier in the county to figure out, for instance, what does it cost to buy 5 pounds of nails, right? Everybody is going to have 5-pound buckets of nails, and if they're the same nails, within probably $1 or so, they're going to be pretty close to the right number. So we don't have to, it makes it simpler for business if we understand that in competitive markets, right, the law of supply and demand is going to drive us to a point where identical things, even if they're in different markets, should still have the exact same price. So that's part 1 of chapter 3, and we'll continue with the next chapter, with the next part.